In 1971, President Richard Nixon shocked the world by announcing that the United States would no longer convert dollars into gold. This decision, known as the Nixon shock, effectively ended the international gold standard and led to a fundamental shift in the global monetary system. The gold standard had been in place for decades and tied the value of currencies to a fixed amount of gold. This system provided stability and confidence in the monetary system, but it also restricted the ability of governments to control their economies. The main reason for Nixon's decision to abandon the gold standard was the mounting pressure on the US dollar. In the post-World War II era, the US dollar had become the world's reserve currency, meaning that it was used by countries around the world for international trade. However, the Vietnam War and a series of domestic economic challenges had created significant inflation and trade deficits for the United States. These economic problems put pressure on the US dollar and threatened its status as the world's reserve currency. By ending the convertibility of dollars into gold, Nixon hoped to regain control over the US economy and alleviate the pressure on the dollar. This decision effectively made the US dollar a fiat currency, meaning that its value was no longer backed by a physical commodity like gold. The immediate impact of Nixon's gold standard exit was a sharp decline in the value of the US dollar on international markets. Currencies of other countries, which had previously been pegged to the US dollar, also came under pressure. In response to the currency volatility, central banks around the world had to take measures to stabilize their economies. Many countries, including Germany, Switzerland, and Japan, imposed capital controls and intervened in foreign exchange markets to prevent their currencies from appreciating too much against the US dollar. The end of the gold standard also led to a surge in inflation. Without the constraint of convertibility into gold, governments could freely print money to finance their deficits and stimulate their economies. This increase in the money supply led to rising prices and a decrease in the purchasing power of the currency. The devaluation of the US dollar and the rise in inflation had significant consequences for global trade. Imported goods became more expensive, leading to higher costs for businesses and consumers. This increased the cost of living and eroded the savings of individuals. Additionally, the lack of a stable monetary system created uncertainty and volatility in financial markets. Investors had to navigate the new landscape of floating exchange rates and unanchored currencies, which added a new layer of risk to their investments. The Nixon shock also marked the beginning of a new era in international finance. With the gold standard abandoned, countries started to explore alternative ways to manage their currencies and stabilize their economies. This eventually led to the establishment of floating exchange rates and the rise of central bank interventions in currency markets. Despite the initial challenges and disruptions caused by Nixon's gold standard exit, many economists argue that it was a necessary step in modernizing the global monetary system. It allowed for greater flexibility in managing currencies and responding to economic shocks. Today, fiat currencies and floating exchange rates are the norm in the international monetary system. Central banks play a crucial role in managing the value of their currencies and promoting economic stability. The significance of gold as a monetary asset has diminished, although it still holds value as a store of wealth and a hedge against inflation. The legacy of Nixon's gold standard exit can still be felt today. It was a pivotal moment in the evolution of the global financial system and signaled a shift towards more flexible and adaptive monetary policies. Understanding the impact of this decision helps shed light on the complexities of modern finance. As we reflect on the events that unfolded in 1971, it's clear that Nixon's gold standard exit had far-reaching consequences that shape the world we live in today. From currency values and inflation rates to trade dynamics and central bank policies, the effects of that decision continue to reverberate throughout the global economy. The aftermath of Nixon's gold standard exit was felt across various sectors of the economy. One significant area that experienced both short-term and long-term effects was the stock market. Investors were faced with heightened uncertainty and volatility as they grappled with the new monetary landscape. In the immediate aftermath of the announcement, the stock market experienced a period of intense selling and panic. Investors were unsure of how the shift away from the gold standard would affect the value of their investments. This led to a sharp decline in stock prices and widespread market instability. The impact of Nixon's decision on the stock market was not limited to the United States. Stock exchanges around the world also experienced significant disruptions and fluctuations as they adjusted to the new monetary reality. The interconnectedness of global markets meant that the effects of the gold standard exit reverberated across borders. In the long term, the stock market adapted to the new monetary system and eventually regained stability. Investors and analysts developed strategies to navigate the ever-changing economic landscape and identify opportunities in the market. The experience of navigating the post-gold standard era helped shape modern investment practices and risk management strategies. One important lesson learned from the gold standard exit was the need for diversification and hedging strategies. Investors realized the importance of spreading their investments across various asset classes, such as stocks, bonds, commodities, and real estate. This approach helped mitigate risk and protect against potential losses. Additionally, the gold standard exit highlighted the importance of staying informed and adapting to changing market conditions. Investors had to closely monitor economic indicators, government policies, and global events to make informed investment decisions. This emphasis on staying informed remains a crucial aspect of successful investing. The impact of Nixon's decision on the stock market extended beyond the initial period of market instability. The shift away from the gold standard set the stage for the restructuring and evolution of the financial industry. Innovations such as electronic trading systems, algorithmic trading, and the rise of mutual funds and exchange-traded funds, ETFs, were all influenced by the changing economic landscape. The gold standard exit also had implications for the valuation of stocks and the overall perception of risk in the market. Investors had to reassess how they price stocks and evaluate their risk potential. This adjustment often led to changes in valuation methodologies and the development of new financial models. As the stock market continued to adapt and evolve, the effects of Nixon's gold standard exit reverberated through different sectors and industries. Some companies and industries were directly impacted by the shift in monetary policies, while others benefited from the changing market dynamics. For example, industries that relied heavily on exports experienced both positive and negative effects. On the one hand, the devaluation of the US dollar made their products more competitive in international markets, leading to increased demand and higher profits. On the other hand, the volatility in exchange rates and the overall economic uncertainty posed challenges for businesses operating in the global marketplace. The gold standard exit also had implications for businesses that relied on access to capital financing. The changes in the monetary system affected borrowing costs, interest rates, and lending practices. Companies had to adjust their financial strategies and adapt to the new economic environment to ensure their continued growth and profitability. In addition to the stock market and various industries, individuals and households were directly impacted by the gold standard exit. The devaluation of the US dollar meant that their purchasing power was diminished, leading to increased costs for everyday goods and services. For individuals who had savings or investments tied to the value of the US dollar, the devaluation meant a loss in real wealth. This, coupled with the rising costs of living, created financial challenges for many households. Individuals had to adjust their spending habits and financial plans to navigate the changing economic landscape. The effects of Nixon's gold standard exit also rippled through the housing and real estate markets. With inflation on the rise, the cost of borrowing increased, making it more challenging for individuals to afford homeownership. Additionally, the uncertainty in the economy affected consumer confidence, leading to fluctuations in housing market activity. However, the changing economic conditions also created opportunities in the real estate market. Investors who were able to adapt to the new monetary system and identify undervalued properties could take advantage of the market shifts. The ability to recognize and capitalize on these opportunities became a key factor in real estate success. The impact of Nixon's gold standard exit was not limited to the stock market and individual industries. It also had implications for government policies and fiscal decision-making. The end of the gold standard allowed governments greater flexibility in managing their economies, but it also presented new challenges in controlling inflation and ensuring economic stability. Monetary policy became a critical tool for governments in navigating the post-gold standard era. Central banks gained increased autonomy in setting interest rates and managing the money supply. The ability to adjust monetary policy in response to economic conditions became essential in maintaining economic stability and promoting growth. The experiences and lessons learned from the gold standard exit continue to shape the policies and practices of central banks around the world. The need for flexibility, adaptability, and proactive decision-making remains crucial in today's dynamic global economy. As we reflect on the impact of Nixon's gold standard exit, it is evident that the decision had far-reaching consequences that permeated various aspects of the economy. From the stock market to individual households, from industries to government policies, the effects of this pivotal moment continue to shape our understanding of economics and finance. The story of how the gold standard exit made money worthless is a complex and multifaceted one. It involves a deep understanding of economic theory, historical context, and the intricacies of the global monetary system. By examining this story, we gain valuable insights into the forces that shape our financial world and the ongoing quest for economic stability and prosperity. Thank you for watching the video. If you reached this far and liked the video, please make sure to subscribe and hit the like button so I can continue to make more content like this. See you on the next one.